There, I can see you.
Okay, can you hear me?
I can hear you as well.
Excellent, okay. Well, thank you very much, Alain. Let's see if we can get the slideshow started here. So good morning, ladies and gentlemen. Thank you for joining me. I think this is our 6th webinar. And what we're going to do today is kind of put together a lot of the things that we've been talking about over the past number of weeks into an overall asset allocation strategy. And by asset allocation strategy, it's just fancy term for essentially saying how one can develop a portfolio, your investment portfolio, using different assets in different mixes. And in doing this, I think that we have to keep in mind that we definitely are in special times, and we're going to be in special times for the foreseeable future. And these special times call for perhaps special strategies that we might not have considered even a year or two ago. So I want to start by our standard disclaimer. Alain has already mentioned this, but want to mention that nothing in this presentation should be considered as advice. I don't know you personally, and also I'm not registered as a financial advisor. The author, me, has no opinion as to the future direction of the stock, commodity, or foreign exchange markets. Actually, every time I have tried to have an opinion, I'm usually wrong, so I've stopped having an opinion. I want to remind you that all investing involves risk. There's no return without risk. And readers should always seek the advice of a registered financial investment advisor or conduct their own due diligence before making any investments. I want to acknowledge also the NAFR Ottawa, Linda Barber and Sarah Campbell for organizing and sponsoring the webinars. Michael Patinode from the Ottawa Share Club, who puts together for every one of these webinars the excellent graphs. Sarah Campbell again for today acting as Zoom master and keeping us all properly under control. And Alain Corriveau for once again acting as host. So let's get started. And generally, when we talk about asset classes, we tend to break them into these 7 groups. So North American stocks, basically Canada and the US. International stocks, meaning everything else. Dividend stocks, which tend to be blue chip stocks that pay healthy dividends and have done so for long periods of time. Bonds, which are simply obligations that are issued either by governments or corporations to borrow money. Preferred shares, which we've talked about in the past, but are simply special kinds of shares issued by corporations that are kind of a hybrid between a stock and a bond, but pay a fixed income as a dividend. Real estate investment trusts, which some of you have become familiar with. These are companies that own a portfolio of real estate assets, shopping centers, retirement homes, apartments, industrial centers, distribution centers, range of things. And then gold and gold miners. And we talk about gold particularly today because the times are so unusual and special. So we have a number of poll questions in this presentation. And so poll question number 1, Sarah, if you could bring that up. Over the next 10 years, do you think that Canadian and US stock markets will, and we'll just wait to see if we can bring up the poll question. Okay, well, we seem to be having a technical difficulty here because I don't see the poll question popping up on my.
We see it, Michael.
Do you?
We see it, okay.
Okay, well, go ahead and vote, and then somebody tell me what the response is because I don't see it. Let me just see if I alt-tab here. Okay, now I got it. All right. So over the next 10 years, do you think that Canadian and US stock markets will? And about 9% say increase by 10% or more, 49% increase between 5 and 10% per year, and 41% 0 to 5%, and 3% think it might decrease. So the top score is increase between 5 to 10% per year, which is a fairly, what I'd say, modest amount of increase that we might be expecting. So let me see if we can go here. So poll question number 2. Over the next 5 years, do you think that interest rates on government bonds will increase, decrease, or stay about the same? Okay, I think everyone's voted. So you can see that the majority of people think that interest rates will stay about the same, which means very low. Interest rates today, as you know, on a GIC are somewhere around 1.5%, 2 if you're really lucky. And on a 10-year Canada government bond, I think the interest rate today is around 0.7. So poll question number 3, over the next 5 years, do you think the price of gold, which is currently about US 1900 per ounce, actually just slightly under today, will increase substantially, increase a little, stay about the same, or decrease? Okay, I think everyone's voted. So most people think it will increase a little, about 10%. 27% say it'll stay about the same. A few think it might increase substantially, and a certain group think it will decrease. Okay, thank you. The reason I ask those questions is that it will flavor, to a certain extent, how you view the rest of this presentation. But thank you for your input, because it's helpful to understand people's perceptions. So before we go into building the asset allocation models, let's just talk a little bit about what's happened over the past number of years. So North American stocks, the blue line is the total US market, total return, including dividends, since about 2013 in Canadian dollars. And you can see that over that period of time, roughly 7 years, it's up 175%. The orange line is the Canadian index, the TSX, and you can see it has not performed nearly as well. It's up 54%. But keep in mind, as we go through this, that 174% number. Now, this is international stocks. The blue line is developed international, so that's Europe, Japan, that sort of thing. And you can see that over the same period of time, they're up about 102%. The gold-colored line is emerging market stocks. They're up only about 54%. As some wag once said about emerging markets, they always seem to be emerging, but never seem to fully emerge. But you got to wonder, with what's happening in the world and what's happening with China, if that might be about to change. Hard to say. But basically we invest in these things, stocks, for capital gains. Then this graph shows you what dividend stocks have done. And the blue line is the iShares Select Dividend ETF total return. And you can see that over about a 10-year period, it's returned 72%, which is about the same as the overall Canadian market, which is the blue line underneath it, which represents the TSX 60, which are the 60 biggest companies on the TSX, who also tend to be, for the most part, big dividend payers. So you can see that the dividends don't give you the same return as the big capital gain stocks, but they also tend to be a little safer, and they pay a fairly constant amount of income. So you're trading off risk versus income. So we keep this in mind again as we go through and build our portfolio. The other thing I want to talk about again, and I talked about this in previous presentations, is the role of bonds. And basically, you think of bonds as, again, portfolio insurance. They're the stopgap when everything else tends to go bad. In this case, the blue line represents the yield on a 30-year US government bond. And you can see that over the past, 3 years or so, that yield has gone down by 45%. So a 30-year US government bond today is paying about 1.7%. However, what happens to the price of bonds is that when yield goes down, the price of bonds goes up. So in that same period, the price of the bonds, as measured by the BMO long-term US Treasury ETF, has gone up 28%. So I want to make the point here that even though bonds may pay very little, as I say 1.7%, bonds can still have a fairly large capital gain because of the inverse relationship between interest rates and the value of bonds. And I know that sometimes people have a tough time understanding why the price of a bond goes up when the interest rate goes down, but it's simply because the bond becomes worth more, because remember, bonds pay a fixed amount of interest no matter what, and when interest rates drop, people are prepared to pay more for those bonds to get that fixed payment. I also want to show you preferred shares. So this is a graph that's going back again about 10 years. The preferred shares are shown in the blue line, and you can see that the total return on preferred shares has been poor, to say the least, down 25%. The reason for this is that a lot of preferred shares were issued where their rates reset every 5 years. And as interest rates dropped, those things kept resetting lower and lower. And in this case, because people were investing in these for income, they kept selling them and the price kept dropping. On the other hand, one might argue that interest rates probably don't have all that much farther to drop. And in that type of a situation, the preferred shares may be a reasonable investment. And I'll show you why a little later. But basically, a preferred share ETF, like the Horizons Active Preferred Share ETF, currently is yielding almost 5.5% as a dividend, which is equivalent to almost 7% in a taxable account, 7% interest. And then I've compared it here to the CI First Asset Canadian REIT ETF. And you can see that it has done considerably better. However, when COVID hit, the REIT ETFs really took a hit, as you can see, that dropping line, because so many of them were retailers, or they were shopping centers, or they were retirement homes. And the value of these REIT ETFs dropped by almost 50% within a month. So as a result, today, the REITs again yield a very large dividend or distribution in the order of 5.4%. Then I want to show you gold and what it has done. So the gold line is the global gold ETF, the actual price of gold. And it's, sorry, the gold line is the gold miners. The blue line is the actual price of gold. And as you can see, what's happened is that since about 2019, the price of gold has increased substantially, gone up almost 60%. And that has influenced the price of the gold miners, which after a very long period of doing nothing has started to rise substantially. But I want to underline that gold miners are a considerably more risky investment than gold bullion itself. And also, as you can see by the fact that over 10 years, they've returned minus 12%, they can go through periods where they don't do much of anything. This slide shows the all-in-one ETFs that we talked about last week and compares a couple of them. This is the Vanguard Balanced ETF in blue. And you can see this only goes back about a year and a half because these all-in-one ETFs only were issued about a year and a half ago. And the gold line is the Toronto Stock Exchange ETF. And you can see that the balanced ETF yielded about 8.5% versus minus 2.5 for the Toronto Stock Exchange. And the point here is that a balanced ETF, and these things hold, if you remember, 60% stocks, 40% bonds. It's the stocks of the world, the bonds of Canada, the US for the most part. And you can see the difference in performance is almost 11% over a 1.5 year period. So the balanced ETFs have performed as they were designed to do, to give a decent return, nothing spectacular, but fairly steady, and they certainly have done better than the Canadian market. Now, a point that I want to make as we go into this is that good investing should be about as exciting as watching paint dry. You know, once you get an investment portfolio set up, the smart thing to do is leave it alone. Don't look at your returns every day or every week. Don't make the mistakes that I do, frankly, looking at it all the time and trying to figure out, well, what can I do a little bit better? There's a great quote that I like. An investment portfolio is like a bar of soap. The more you handle it, the smaller it gets. And my experience is that that's very true. I often catch myself, you know, getting bored, wanting to do things, wanting to tinker. And my experience over 20 years has been, I would have been a lot better off just to leave it alone, go away, you know, stop watching BNN or CNBC. So let's do one more poll question here. Over the next 5 years compared with today, you think that investors will incur more uncertainty, less uncertainty, about the same level of uncertainty, or uncertain uncertainty? Okay, I think everyone's voted. So we can see that the largest number of people think that we will experience about the same level of uncertainty, which means a lot. Some say even more uncertainty. And of course, uncertainty is almost what we have now, isn't it? Without knowing really what is going on in the world. But the point here is that there is a lot of uncertainty, and we have to try to design a portfolio that takes that into account. So here's a quote from a fellow who writes in the Wall Street Journal. The trick of investing is to embrace uncertainty without fooling yourself into thinking that impetuous decisions can give you control over it. Individuals have a critical forecasting advantage over professionals. A guru, say on TV, who often says, "I don't know," won't be invited back. So, you listen to these talking heads on TV and they're all spouting off and sounding very knowledgeable. And I recall recently I was listening to one fellow being interviewed on BNN, and he sounded very good. I thought his analyses were excellent. I thought, this guy makes a lot of sense. And then they showed his past picks and how they had done. And 2 out of 3 of his past picks lost like 20-25% over the past year. And I'm thinking to myself, so these are the sorts of people they bring on TV who are 2/3 wrong? I don't think so. So here are the key concerns as we've been discussing when we're selecting an asset allocation strategy. First of all, interest rates may stay near zero for a lot longer. And as a number of you have indicated, that is a reasonable expectation. It's going to take, I think, years to recover from COVID and years for the economy to get back in shape again. And by the time we do get over it, we will have borrowed so much money. Governments around the world are going to be in so much debt. It's going to take a long time to recover. Capital appreciation of stocks may be limited because of slow economic growth. The value of stocks over time is related to their earnings growth. Earnings growth is related to economic growth. And if you don't have economic growth, you don't have overall earnings growth, and it's very hard to get stock prices going up in that case. Uncertainty, as you pointed out, is likely to be the norm, and investors don't like uncertainty. They like to have a clear idea of the future. And as you said in your own polling, the future looks uncertain. And I want to just use this graph on the right to remind you of a point. If you look at the blue line, from here, this was early 2000, which was the top of the dot-com craze. And if you go across all the way to here in about 2013, this blue line represents the S&P 500. 13 years and the S&P 500 was back to where it was in early 2000. So the only thing that investors made in that period of time was 2%. But in that period of time, you had the S&P 500 dropping 40-45% by 2002, and dropping again 45-50% in 2008-9. It was an awful tough time to be an investor and hold your nose and not go and sell. So my point is that going forward, I think that we have to be prepared. I don't know if it's going to happen, but we have to be prepared for this kind of future. And you folks said it yourself, it's uncertain, and investors don't like uncertainty. So again, GICs at 0.6 to 1.6 are hardly going to keep up with inflation after tax. Bonds work as a circuit breaker. So when everything else goes bad, bonds tend to do well. Gold has negative correlation to stock markets. So it means over a period of time, gold tends to do opposite to what the stock markets do. And beaten up dividend stocks, per shares, and REITs offer attractive relative yields right now. In fact, the yields are really quite amazing when you compare them to what you get, say, in a GIC. So here is some sample portfolios. So the first one is an asset accumulation portfolio. So this is for somebody who is still wanting to build their portfolio. And I realize that's not most of us, but maybe you've got a son or grandchildren or daughter, and you want to give them a little advice. This is a very simple approach to it. You use, and remember, these are only examples and they're not here as recommendations because I don't know your personal situation. But if we start by using VBAL, which is the 60-40 balanced all-in-one ETF, put 80% of that into our portfolio. It has a yield of 2% and it has a management expense ratio of 0.25, which is about 1/8 of what a typical managed mutual fund is. And if you remember, the nice thing about these all-in-one ETFs is that they're professionally managed for you. You don't have to do a thing once you buy it. XGD is the gold miners ETF. For uncertain times, having some gold in a portfolio could be a good idea. It doesn't yield very much. The MER is a little on the high side, but this ETF has returned about 40% in the last year as uncertainty unfolded. Always a good idea to keep some cash around or in GICs so that if the market does tank again and things go on sale, you have an opportunity to pick up some bargains. The other thing I'll mention that you may not have heard about are DRIPs. DRIPs are dividend reinvestment programs. And basically, any brokerage can set this up for you. And if you're in an asset accumulation phase, you don't need the income from your investments. A DRIP will automatically reinvest the distributions into new shares or units of ETFs or mutual funds. It's usually done by the broker at no cost. Sometimes the company providing the DRIP even allows you to buy the new stocks at a small discount, 2-3% to the market price. And it's available through your broker on most ETFs and Canadian companies. So just something I wanted to remind people about if they hadn't heard of DRIPs. Great way to accumulate money over a long period of time. This portfolio is for somebody who's got a RIF, who's got to try to meet the mandatory minimum withdrawals, which at age 72 is now 5.2%. So in this case, the idea would be to use an all-in-one ETF such as VRIF, which is designed to provide 4% per year in good times or in bad. It has an MER of 0.25. XDV is the Canadian Dividend stock ETF. It's currently yielding 5.5%. HPR is a Canadian preferred share ETF. It's currently yielding 5.4%. And RIT is a Canadian real estate investment trust ETF, currently yielding 5.3%. So you can see that with these yields, you're getting closer to that mandatory minimum. Always a good idea to keep some cash or GICs around in a RIF in case the stock market tanks. You don't want to have to sell your stocks or your ETFs when things have really dropped a lot. So it'd be nice to have some cash available to meet those minimum withdrawals without forcing you to sell things on sale. And this portfolio has a weighted average return of about 4.4%. Weighted average simply means you take the amount that you have in each investment, you multiply it by the yield, you total it up. So it's getting close to the 5.2, and it gives you a fairly balanced approach with not too much risk. There is risk, always is risk, but hopefully, because we might be buying these ETFs when the market is low, we are going to keep risk fairly low. Next, I want to talk about taxable income portfolio. So if you've got investments in a taxable account, I just want to remind people the huge difference between the tax rate on dividends versus interest or other income. You can see in this band that many people are in from 48,000 to 78,000. This is personal, individual taxable income. You can see that on dividends, the total tax rate in Ontario is about 6%, where on interest, it's 29%. And depending on which tax bracket you're in, it makes an awful lot of difference. If you're under 48,000, your tax on Canadian dividends is actually slightly negative. In other words, for every $100 in dividends, you would actually get $101.20 in tax credits. That's the best deal in town. So the sort of portfolio that you would then build would be a little bit different, but not much. The main difference is that we would replace VRIF with VBAL to give you more bonds in your portfolio. But the other things would stay pretty much the same to give you these tax efficient dividends. And remember, the normal adjustment for dividends to interest in a taxable account is to increase the dividends by 30%. So it gives you an estimate. So for example, here, a 5.5% dividend is equivalent to about 7% interest. And where can you get 7% interest on anything? Nowhere. Always a good idea to keep some cash around, particularly in these uncertain times. You know, there may be some great deals if the markets tank. And you can see that the weighted average return here is about 3.6%. But again, this is highly tax efficient. So the real interest equivalent is closer to 5. Tfsa, again, fairly simple approach. You can take a bit more risk because it's tax-free. Use either VBAL or its sister VGROW, which is 80% stocks, 20% bonds. And then perhaps a bit of XGD, which is the gold miner ETF. And by the way, I want to remind people, I use VBAL VGROW simply because Vanguard, who issues it, it's sort of was the originator of these. But these similar products are issued by iShares, by BMO, by Horizons, and they're all equally good. They all charge about the same MER, and the only difference is that they have a slightly different mix of, you know, international versus Canadian stocks. But any of them would be, I think, acceptable. I just want to mention quickly our Esp portfolio. If you are investing on behalf of, say, a grandchild, again, you can use these all-in-one ETFs. If you're 10 years or more out before the child needs the money, you can use something like VGROW, which is 80-20 stocks bonds. As you get closer to that time where the child's going to need the money, you want to get more conservative. So you go to VBAL and then to VCNS, which is a 40-60 stocks bonds. But when you get into that period, 0 to 3 years before they're going to use or need the money, you go to cash or close to it and eliminate risk. The last thing you want is to have invested all this money, have the stock market crash just before the child's going to need the money. So disclosure, the presenter, myself, and my family own the following investments. We have VBAL, XGD, XPR, and RIT. So just to prove that I eat my own cooking. I want to remind folks that our next upcoming webinar, November 25th, is how to choose an investment advisor, advisor with an E, not an O, and we'll explain the difference. So you're welcome to tune in. And finally, I want to mention to people that we'd love to hear from you for ideas for new topics. We'd like to continue this webinar series into 2021. We've appreciated the support and the interest. So please feel free to send me your ideas to investingforretirees@gmail.com. And we'll leave this, the screen will be up and this address will be available on the NAFR website. But really would look forward to getting your ideas for 2021 webinars. And finally, I just want to say that, remind people that things, and particularly investments, are seldom as advertised. For example, the Panama hat, which you'll soon see me wearing, is actually made in Monte Cristi, Ecuador. Although this picture I took in Panama City, Panama, and it just reminds us that things are not always as advertised. And with that, I'll turn it back over to Alain.